Hey everyone, today we'll talk about fractional reserve banking system and the money multiplier effect that happens from it. We'll cover this in conceptual and then in practical way. But before we go ahead, I strongly encourage you to check out my initial video on modern monetary theory. The link is in the description. So let's begin. What is fractional reserve banking? It is a system wherein banks need to set aside a percentage of their deposits as reserves and they can lend out the rest. This creates a chain of events that ultimately ends up with credit expansion. That is the money multiplier effect that we are talking about here. So let's take an example. Let's say 100 rupees was deposited in Bank A. So Bank A, if reserve requirement stipulated by RBI is 10%, then Bank A can lend out 90 rupees from it. Now this 90 rupees is disbursed to another account which let's say is in Bank B. So now Bank B also has a deposit of 90 rupees, out of which Bank B has to maintain 9 rupees, which is 10% of 90 rupees as reserve, and it can lend out 81 rupees of it. So this creates a chain of events that ultimately ends up creating credit of 1000 rupees. So ultimately the credit creation is equal to initial deposits into 1 upon the reserve requirements. That is 100 rupees into 1 by 0.1, that is 1000 rupees credit creation. This is a very simplistic view to understand the impact of changes in reserve requirements, how those will affect the ultimate credit creation or the money supply within the economy. But this is only good for a intuitive understanding, but it is not a very complex or a comprehensive one. In real world, things are a bit more complex. In real world, banks do not wait for new deposits in order to make a loan when they come across a creditworthy customer. They would make the loan and then they would look to bridge the liquidity shortfall through one of the RBI's short-term liquidity management tools. Let's look at two most significant such tools. First one is call money market and second one is RBI's Liquidity Adjustment Facility. Let's look at an example to understand this better. First, let's see how call money market works with the help of a few transactions. Suppose Bank A lends rupees 100 crore to corporate borrower. It essentially is creating a loan asset and a deposit liability of 100 crores. Then in transaction 2, borrower transfers that money to a customer who has an account in Bank B. So Bank A transfers reserves of 100 crore rupees to Bank B through RBI settlement process. This creates liquidity shortage at Bank A and liquidity surplus at Bank B. Now let's assume there's another loan disbursed to another customer of 150 crores. In transaction 3, we have an increase in loan assets and an increase in deposit liability of 150 crores each. This time, if we assume that the transfer from the depositor has happened to another customer within the same Bank A, the change will happen only within the liability side of the balance sheet of Bank A. At this point, for Bank A, total deposit liability is 150 crores, loan assets is 250 crores, and there's a reserve shortfall of 100 crores. Whereas for Bank B, there's a reserve surplus of 100 crores against which it doesn't have a loan given. Hence, Bank A would borrow those excess reserves from Bank B in interbank call money market. It's also important to note that this is only a short-term transaction to meet short-term liquidity requirement. The banks will need to eventually calibrate their assets and liabilities to fix asset-liability mismatch. Also, even now, there's an asset-liability mismatch as assets are long-term in nature. Typically, they are loans for 15 years, 10 years, etc. Whereas borrowings in call money market are very short-term in nature, typically overnight to fortnight. So after this call money market transaction, Bank A has no liquidity shortfall and Bank B has no liquidity surplus temporarily. Now let's look at another example. When the corporate customer has paid 25 crore rupees from his account to the government. This leads to money going out of banking system into the central government's account, which is held in RBI. In this case, interbank borrowing cannot fix the shortfall for Bank A, as the money has not moved to another bank. In this case, banks borrow from RBI under repo by pledging government securities, and RBI provides cash by increasing the reserve. So, like we saw, lending transactions within and between accounts for commercial banks leads to expansion of money, which is also called M1 money. But it creates asset liability mismatches between the banks, which is bridged through interbank borrowing and lending. And in case of Liquidity Adjustment Facility, central bank balance sheet expands and temporary new base money or M0 gets created. Hence, call money market redistributes liquidity within the system, whereas Liquidity Adjustment Facility injects or drains liquidity from the system. So to summarize, Fractional Reserve Banking system is a simplistic and a very intuitive way to understand the impact of tweaks in reserve requirement on the overall money supply or trade creation within the economy. But in reality, things are a bit more complex. In reality, credit expansion is a function of demand for credit, which itself is a function of underlying economic drivers. In the next video, we will dive deeper into each one of these factors of call money market and Liquidity Adjustment Facility. Till then, thank you and see you in the next video.